You know that feeling? You're working hard, the company seems to be doing great, maybe you even see headlines about record profits, but somehow that success, it just isn't really reaching your paycheck. Like, you feel like you're giving it your all, but maybe not getting your fair share back.
Yeah.
Well, if that rings true for you, you are definitely in the right place today.
Yeah, absolutely. Because in this deep dive, we're getting into a really core issue in the U.S. economy over, well, the last 40 years or so.
Right.
It's this growing gap, this disconnect between these huge corporate profits we hear about and the wages that everyday working people are actually earning.
Exactly. And we've been looking through some really compelling analysis to try and unpack this. We want to get past the sort of surface level explanations. Our mission here is to figure out, okay, where is that money going if not into wages? And what are the forces driving this? For you listening, it's about getting a much clearer picture of these economic dynamics.
So maybe let's start with just how stark the contrast is. Looking at some 2024 numbers, Apple, for instance, pulled in, what, $93.7 billion in profit?
Wow.
Alphabet, that's Google's parent company, actually topped that $100.1 billion.
$100 billion.
And even ExxonMobil, navigating all the changes in energy, still made a really solid $33.6 billion. I mean, these are just colossal amounts of money.
They really are mind-boggling figures. And then you hear stories like some contract workers at Alphabet, they're earning around $14.50 an hour.
Right.
The difference is just, it's jarring, isn't it? $100 billion in profit floating around up top, and some folks actually contributing to that are, really struggling. It just makes you ask, where is the disconnect? What's going on?
Well, this is where the work of economist William Lazonick really comes in handy. He's looked deeply into how corporations actually use their profits. And he argues that these huge sums, they're not mainly being reinvested in the workforce, the people who actually help generate them. The idea basically is that shareholder primacy, prioritizing shareholders, has kind of taken over.
Taken over from what, though?
Well, from maybe an older idea of stakeholder capitalism, where you consider everyone involved workers, communities, not just investors. Now it seems much more focused on short-term financial gains for those investors.
Okay, so Lazonick's research suggests the money isn't going primarily to wages. Where is it going then?
His analysis points to a few key places. Number one is stock buybacks, huge amounts being spent where companies repurchase their own shares.
Right, I've heard about those.
Then you have increased dividend payouts, again, going to shareholders. Also, very high executive compensation packages. And interestingly, a lot of capital flowing into things like hedge funds.
Hedge funds, how do they fit in?
Well, hedge funds aim for high returns, often fueled by this very corporate profitability.
Yeah.
So it's another avenue where the money flows out, often benefiting investors rather than being reinvested internally.
The scale of this, it's almost hard to grasp. Just in 2024, you mentioned Apple, they spent nearly $95 billion buying back their own stock.
$95 billion, almost dollar for dollar with their profit.
And Alphabet, over $62 billion. ExxonMobil, nearly $20 billion. I mean, these aren't companies short on cash, are they?
Not at all. And spending almost as much buying back stock as they made in profit, like Apple did, that's a very direct return to shareholders. It's not necessarily going into R&D or worker paychecks.
Yeah.
And this gets really interesting when you look at specific cases. Take General Motors, GM. Remember the big United Auto Workers strike back in September 2023?
Oh, yeah, that was huge. Felt like a real pushback from the workers for a fairer deal.
It absolutely was a landmark moment, like you said. But get this. In that same year, 2023, GM spent over $11 billion on stock buybacks.
$11 billion, while the workers were striking for better pay.
And then in 2024, they allocated another $7.1 billion for buybacks.
So even as workers are fighting tooth and nail and actually winning some games, the company is simultaneously pouring enormous sums into boosting its stock price, which, let's be honest, mostly benefits shareholders and the execs, right?
That is precisely Lazonick's point. He really emphasizes that this focus on buybacks often directly competes with or comes at the expense of other crucial investments.
Like what kind of investments?
Well, like better wages and benefits, obviously, but also funding research and development, investing in future tech like electric vehicles for GM, or even just basic employee training programs. The priority shifts, away from long-term growth and shared prosperity.
Towards just hitting those short-term financial targets for Wall Street.
Exactly. Delivering those gains for a pretty select group.
Now, okay, often when we talk about wages being stuck, people point to globalization, jobs moving overseas. How does this analysis account for that?
Yeah, globalization is definitely part of the bigger picture, no doubt. But this specific analysis suggests it's maybe not the main reason for this particular gap, the one between profits and wages within these highly profitable American companies. People often talk about tariffs, right, as a way to bring jobs back, maybe push wages up.
Sure, that's a common argument.
But Lazonick's view, based on this analysis, is that tariffs don't really fix the core problem, which is how these profitable companies decide to spend their money once they make it.
Ah, okay. So even if tariffs brought some jobs back, a company making huge profits could still choose to pour that money into buybacks instead of significantly raising wages for those workers.
Precisely. The analysis actually mentions Lazonick, citing UAW leader Shawn Fain supporting tariffs, which makes sense from a jobs perspective.
Mhm.
While at the same time, Lazonick calls the amount GM spend on buybacks outrageous. The point is, the jobs might return, but the underlying model for sharing the financial benefits hasn't necessarily changed. The profit allocation issue remains.
So this whole situation, this big gap between company profits and worker pay, has it always been this way in the U.S.? Or is this something newer?
That's a really important historical question, and the analysis suggests no, it wasn't always the norm, especially if you look back to the mid-20th century.
Right.
Now, we have to be careful, right? That era had its own major issues, especially around who actually got to share in the prosperity. Big limitations there.
Understood.
Uh,
Generally speaking.
Generally, there seemed to be a much stronger connection back then. When companies became more productive, a good chunk of those gains often flowed through to workers in the form of better wages, better benefits.
So if the company did well, the employees tended to do better too. There was more of a shared sense of progress.
That seems to be the case, yeah. And alongside that, there was maybe more of a societal expectation that successful companies and wealthy individuals too would pay a larger share in taxes.
Which then funded public services.
Right. Things like education, infrastructure, the stuff everyone relies on. The analysis argues pretty strongly that this link between company success, worker rewards, and societal contribution has been, quote, severed.
Severed. That's a strong word.
It is. And the reason given is this increased focus on, as they put it, Wall Street schemes over workers.
Wow. That phrase really hits home, doesn't it? Now, the analysis also brings up something called the cost disease. What's that about?
Okay, yeah, the cost disease. This comes from another economist, William Baumol. It's a fascinating idea. Basically, he looked at different parts of the economy. In industries that make goods like tech, manufacturing productivity can often shoot up over time thanks to technology and innovation. Costs can come down. Think about how much cheaper computers or TVs get.
Right. Moore's Law, that kind of thing. Technology drives efficiency.
Exactly. But then Baumol looked at service industries, education, healthcare, maybe performing arts. And he noticed it's much harder to get those same dramatic productivity gains there. A teacher can only teach so many kids effectively at once, right? A nurse needs time with each patient.
Sure. The human element is key. You can't just automate teaching or care in the same way.
Precisely. But the people working in those service jobs still need to earn a decent living. Their wages need to keep up with wages in the goods-producing sectors.
Ah, I see. So because productivity doesn't rise as fast in services, but wages still need to keep pace, the relative cost of those services goes up over time compared to goods.
You got it. That's the cost disease. It's not that services are necessarily getting worse. It's that their cost rises relative to goods where productivity is booming.
Okay, I think I understand the concept. So how does that connect back to the corporate profits discussion we were having?
Well, Baumol's original idea, or at least a potential implication, was that maybe the huge profits coming from those super productive goods sectors could, theoretically, be used to help support and fund those essential but less productive in the economic sense service sectors, like education and healthcare. Keep them high quality and accessible.
Okay, that makes sense. Use the gains from one area to support another vital area.
But, and this is where the analysis brings it back to Lazonick's work, that's largely not what's happening. Instead of helping fund schools or hospitals, a big chunk of those profits from, say, Apple or Alphabet
is going into the stock buybacks and dividends we talked about.
Exactly. Primarily enriching shareholders and executives, who are already likely doing pretty well.
And the potential downside, then, is that those vital public services, the ones affected by the cost disease, might end up underfunded or facing cuts because the resources aren't flowing there.
That's a major concern raised in the analysis, yes. It suggests this misallocation of profits doesn't just widen the gap between the rich and everyone else, it could actually weaken the very social foundation. Good schools, good healthcare that we need for a healthy society, and frankly, a productive long-term economy.
So it sounds like this trend, prioritizing financial payouts over workers, it's happening even in those high-flying, super productive industries themselves, like tech and advanced manufacturing.
That's a really key point from the analysis. Even in sectors where you see incredible innovation, think developing cutting-edge computer chips or life-saving drugs.
Yeah, things that cost a fortune to research and develop initially.
Right, huge upfront investment. But once that tech is developed, actually producing the chips or the pills can become incredibly cheap and scalable. You can make millions or billions of them relatively easily.
Generating massive profits.
Massive profits. But the analysis points out that the workers involved in that ongoing production, distribution, the ones actually making and shipping those profitable goods, their compensation isn't necessarily rising anywhere near in proportion to those huge profits being generated.
So the value created isn't being shared equitably even within those innovative sectors.
That seems to be the argument. The focus remains on channeling those profits back to shareholders and executives.
Okay, so if the argument is that using these massive profits, mainly for buybacks and dividends, isn't ideal, what's the alternative vision? According to this analysis, what should companies be doing with their profits?
Well, the analysis, really drawing heavily on Lazonick's perspective here, argues for a pretty fundamental shift in corporate priorities.
How so?
It suggests profits should be, first and foremost, reinvested back into the company's foundation, its workforce. That means better wages, yes, but also better benefits, real investments in training and skill development.
Okay, strengthening the core workforce. What else?
Beyond that, the argument is that a larger share of these corporate profits should flow back into society to support those essential public services we rely on.
Like the ones affected by the cost disease.
Exactly. Quality education, affordable and accessible healthcare, public safety, protecting the environment, even supporting arts and culture. The idea is that these vital areas shouldn't be solely dependent on or driven by a narrow profit motive.
It sounds like it's circling back to that idea of shared prosperity, doesn't it? The notion that companies don't exist in a vacuum.
Precisely. They operate within a society. They benefit hugely from public infrastructure, from an educated workforce, from publicly funded research sometimes.
Right.
And their success is absolutely built on the hard work of many, many people. So Lazonick's core belief, as presented here, is that because corporations benefit from society, they have a responsibility to society
Which means paying workers fairly.
and contributing their fair share through taxes to support the public services that create a good quality of life and ultimately a stronger economy for everyone.
So when you put it all together, it's not really about just a few greedy CEOs, is it? The analysis seems to be painting a picture of something more systemic.
I think that's a really critical takeaway. Lazonick explicitly frames it as a systemic failure. The argument isn't just that individual companies are making bad choices, but that the whole system, the way corporate profits are generated and allocated, has gone wrong.
How so? Systemic failure.
Well, the idea is that these huge corporate profits often rely heavily on public investments, taxpayer money that funded basic research, built infrastructure, educated the workforce.
Okay.
But then when those profits materialize, they get funneled into these financial maneuvers like buybacks that mainly benefit a small group. It's not just unfair, the argument goes, it actually might undermine the very public investments that made the profits possible in the first place.
It kind of challenges that whole trickle-down idea, doesn't it? The narrative many people have heard for decades that if corporations just do well, eventually everyone benefits.
It really does push back against that. What this deep dive into the analysis suggests is, look, the wealth is being generated. That part's true. The problem is where it's going.
It's being directed elsewhere.
Yeah. And just hoping for, say, tariffs or some other broad policy to magically fix wages might be missing the deeper issue of how profits get divided up inside these incredibly successful companies. The central argument seems to be that if we want a truly strong, fair, resilient economy, the focus can't just be on growth for growth's sake or just maximizing shareholder value above everything else.
It needs to shift.
It needs to shift towards actively prioritizing, shared prosperity, making sure economic activity leads to genuinely better lives for the people actually doing the work and contributing to that activity.
So wrapping this up then, after digging into these sources, The main takeaway seems to be this really significant change over the last, 4 decades
Yeah, a real transformation.
in how corporate profits get used.
Hmm.
A definite shift away from investing in the workforce or the broader public good and towards these financial strategies, these maneuvers that end up primarily benefiting a relatively small elite.
I think that sums it up really well. And it definitely makes you pause and think about the wider consequences, right? Not just for you or your neighbor, but for the health and fairness of our communities, our whole economy.
Absolutely. It kind of leaves you with a big question, doesn't it? If these huge corporate profits really do depend so much on public investments, on the labor of countless people, what would a truly fair way to share those rewards actually look like in the 21st century?
Yeah.
It really pushes you to think about different economic priorities, ones that go beyond just creating jobs and really focus on, creating better lives for everyone involved.